Ever wondered how your money pulls all-nighters for you? Or how some folks seem to multiply their pennies while sitting on their couches? The hush-hush could be in mutual funds and segregated funds. Welcome to the hilarious roller coaster ride through the secret world of these financial wonders. Picture a swimming pool, a cash-filled pool, where different investors like us let our sweat-soaked pennies take a dive into the hands of a financial wizard, the fund manager. This is the core of a mutual fund. Our collective dough is then splashed across an array of assets, from stocks and bonds to real estate and more. The end game? To hit the jackpot and dodge the crashes. Now imagine the same pool, but with a lifebuoy. Say hello to a segregated fund. It's an investment fund, but dressed up in an insurance suit, promising security on your investment potential immunity from debt collectors. Quite a comfort blanket, right? Basically, both mutual and segregated funds are investment taxis, driving your money to work faster and smarter. They are the MVPs in the finance league, stirring economies and molding lives. These financial wizards didn't just pop out of a magic hat one sunny day. They have a colorful past, knotted with the progression of banking systems and the life insurance field. Pioneers have left their footprints in their journey, and intriguingly, their tales are as assorted as the they championed. From the buzzing neighborhoods of New York to the vintage backdrop of London, the ripple of these funds is worldwide. They have been key in amassing fortunes, safeguarding dreams, and quite literally, the world around. But what's the origin story? How did mutual funds sprout? What sparked the birth of segregated funds? How do they measure up against each other, and what's the current scenario? Well, as they say, to admire the charm of a tree, you must first dig into its roots, so let's buckle up for this laugh-out-loud adventure, diving into yesteryears to make sense of today and guess tomorrow. Ready for a chucklesome ride down the memory lane to decode these financial tools? Fasten your seatbelts. The year was 1774, and a financial revolution was underway. We're not talking about the Boston Tea Party here. No, this was a revolution of a different kind. One that was brewing in the heart of Europe, in the Netherlands to be precise. In the midst of all the tulips and windmills, a quiet financial innovation was taking shape. One that would forever change the way we invest. The Dutch, known for their innovative spirit, were about to give birth to a financial instrument that would become the backbone of modern investment strategies, the mutual fund. Man at the forefront of this revolution was none other than Abraham van Ketwich. You might not recognize his name, but his contribution to the financial world was groundbreaking. Van Ketwich was the mastermind behind the first ever mutual fund, appropriately named Eendracht maakt macht, which translates to Unity creates strength. And indeed, it was the unity of investors pooling their resources that created the strength of this new investment vehicle. Ketwich's mutual fund was a response to the financial crisis of the late 18th century. Much like a superhero swooping in to save the day, Van Ketwich's mutual fund gave small investors a chance to diversify their investments and spread their risk, a concept that was revolutionary for its time. Let's not forget Adrian van Ketwich, Abraham's equally innovative cousin. He took the concept of mutual funds a step further by introducing the concept of closed-end funds. This was like the sequel to a blockbuster movie, adding a new twist to an already successful formula. So there you have it, folks. Amidst the hustle and bustle of 18th century Europe, amidst the political upheavals and the wars, a quiet financial revolution was taking place. The Dutch, with their innovative spirit and financial acumen, were setting the stage for what would become a cornerstone of modern investment strategies. Mutual funds were born, ready to change the financial landscape forever. From its humble beginnings, the mutual fund industry was destined for growth. As the world of finance expanded, so too did the thirst for a platform that allowed pooling of resources. That's where mutual funds stepped in, offering a ticket to the investment party for everyone, not just the financial elite. An exciting turning point came in the mid-20th century. A gentleman named John C. Bogle, fondly known as Jack, brought a revolutionary idea to the table. He introduced the world's first index mutual fund in 1975, a concept that was initially met with skepticism but soon proved to be a game changer. This was the birth of the Vanguard 500 Index Fund, a fund designed to mimic the performance of the S&P 500. Jack's idea was simple yet profound. Instead of trying to beat the market, why not match it? From then on, the mutual fund industry experienced a snowball effect. An increasing number of fund houses started to spring up, offering a variety of fund types to suit different investor appetites. We saw the rise of bond funds, sector funds, money market funds, and so much more. The landscape was diversifying, and mutual funds were at the heart of it. Fast forward to the 90s, and another milestone was hit. The advent of the internet brought a new era of transparency and accessibility. Now investors could easily compare funds, track performance, and make informed decisions like never before. It was a digital revolution that transformed the mutual fund industry. And let's not forget the introduction of exchange-traded funds, or ETFs, in the early 90s. This innovation allowed mutual funds to be traded like stocks, offering unprecedented liquidity and flexibility. But the journey wasn't always smooth sailing. The industry faced its fair share of challenges, like the dot-com bubble and the 2008 financial crisis. Yet it continually adapted and emerged stronger each time. And so, mutual funds continued to evolve, but they weren't the only game in town. As we'll see next, another financial instrument was ready to step into the limelight. While mutual funds were making waves, a new player entered the field. As the world was getting comfortable with the concept of mutual funds, a fresh contender came onto the scene: segregated funds. This was not just another financial instrument, but a game changer, which brought with it a unique blend of investment and insurance. Segregated funds emerged from the heart of the life insurance industry. Imagine the intensity of a football derby, where two rival teams are battling for supremacy. That's how it was when segregated funds entered the financial arena, ready to take on the established might of mutual funds. One of the key figures behind the rise of segregated funds was a gentleman named Sir Edmund Halley. Yes, that's right, the same Halley who is renowned for calculating the orbit of the comet that bears his name. But his contributions were not limited to astronomy. He was also a pioneer in the field of life insurance, and his work laid the foundation for segregated funds. In the late 17th century, Halley developed a life table, which was a statistical tool that allowed insurance companies to calculate premiums based on age and mortality rates. It was a groundbreaking piece of work that revolutionized the insurance industry, and it was this life table that later paved the way for the development of segregated funds. Let's fast forward to the 20th century. The life insurance industry was booming, and with this boom came the introduction of segregated funds. These funds offered the growth potential of mutual funds, with the added security of an insurance guarantee. It was like having your cake and it too. As the popularity of segregated funds grew, so did their complexity. The industry began to introduce a variety of different funds, each with its unique features and benefits. It was like a smorgasbord of financial delights, ready to cater to every investor's palate. Segregated funds had made their mark, and the comparison with mutual funds is intriguing and compelling. Let's continue to revel in the excitement of this financial innovation that changed the game forever. It was the financial showdown of the century: mutual funds versus segregated funds. Picture this. Mutual funds and segregated funds are like two distant cousins, both belonging to the broad family of investment funds. They are similar in many ways, yet each has its unique characteristics that set them apart. Let's dig a little deeper into this intriguing family drama. Mutual funds, the older of the two cousins, are a popular choice for many investors. They pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other securities. The value of your investment in a mutual fund fluctuates with the market value of the securities it holds. It's like being part of a big, diverse family where everyone pitches in and shares the wealth or the losses equally. Funds, on the other hand, are a bit more exclusive. They're a type of insurance product offered by life insurance companies. The unique selling point of segregated funds is their guarantee. They promise to return a minimum percentage of your original investment, even if the market takes a nosedive. It's like having a safety net in case things go south. Of course, this safety comes at a price. Segregated funds typically have higher management fees than mutual funds. It's like paying a premium for that extra layer of security. What's the verdict in this financial showdown? Well, it's not as simple as declaring a winner. Both mutual funds and segregated funds have their place in the investment landscape, and the choice between the two depends on a variety of factors. You're more risk-averse and don't mind paying a bit extra for guaranteed returns, segregated funds might be the way to go. But if you're comfortable with some level of risk and are looking for lower costs, mutual funds could be a better fit. So whether it's mutual funds or segregated funds, the choice depends on your financial goals and risk tolerance. Fast forward to today, and these financial instruments are more relevant than ever. You see, mutual funds and segregated funds have become a cornerstone of the modern financial world. Let's start with mutual funds. These investment vehicles have evolved to offer a plethora of options to cater to various investor profiles. From equity funds that invest in company stocks for those who can stomach a bit of risk, to debt funds for the risk-averse who prefer the safety of fixed returns. There's something for everyone. And then we have balanced funds, which, true to their name, aim to strike a balance between risk and reward by investing in a mix of equities and debts. Now, onto segregated funds. These darlings of the life insurance industry have evolved in their own unique way. They become a popular choice for individuals looking for investment growth coupled with insurance benefits, not to mention the allure of creditor protection and potential estate planning benefits. Like mutual funds, segregated funds also offer a variety of investment options. But what sets them apart is the guarantee they offer on your investment, typically between 75 to 100% of your initial investment, depending on the specific fund and contract. Today, both mutual and segregated funds play a crucial role in portfolios across the globe, helping millions of people grow their wealth. They're not just for the Wall Street whizzes, but also for the everyday Joe looking to make his money work harder for him. And let's not forget the institutions. Banks, insurance companies, pension funds, they all use these financial instruments to manage their vast pools of money. It's a symbiotic relationship, really. The institutions provide the funds with much needed capital, and in return, they get a diversified, professionally managed portfolio. Whether you're a finance enthusiast or just looking to grow your wealth, understanding mutual funds and segregated funds can give you the edge. So, what have we learned from our historical journey? We've embarked on a riveting journey through the annals of finance, shedding light on the intriguing world of mutual and segregated funds. From their humble beginnings to their modern-day prominence, we've seen how these financial instruments have been instrumental in shaping the global economy. Take a moment to revisit the birth of mutual funds. Remember, this was a revolutionary idea hatched centuries ago, a solution designed to allow ordinary people to pool their resources and invest collectively. It was a game changer, providing an opportunity for many to participate in the financial markets, a realm once reserved only for the wealthy. Then we delved into the evolution of these funds, witnessing the myriad changes and adaptations they've undergone to remain relevant and effective. We saw how they weathered the storms of economic downturns and rode the waves of financial booms, continuously evolving and adapting to meet the needs of investors. Also explored the emergence of segregated funds, a relatively new player in the financial world. As a hybrid of mutual funds and life insurance, these funds offered a unique blend of investment potential and insurance protection. They demonstrated once again the innovative spirit that drives the financial industry, always seeking new ways to serve the needs of the public. Compared and contrasted mutual funds with segregated funds, highlighting their unique features and benefits. Each has its own merits and drawbacks, and understanding these is key to making informed investment decisions. Concluded with a look at the modern landscape, where mutual and segregated funds continue to play a pivotal role. They have become essential tools for individuals, companies, and even nations to grow their wealth and secure their financial future. And there you have it, a whirlwind tour of mutual funds and segregated funds. Remember, your money can work for you. All it needs is a little bit of financial wisdom.